Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Joe Cavatoni, market strategist at the World Gold Council, as well as Kevin Mahn, chief investment officer of Hennion and Walsh. And we're here to discuss how investors are thinking about decision-making as the election cycle plays out. Gentlemen, it's great to see you as always. Welcome back to Trade Talks. Great. Kevin, 6 weeks ago to where we are now, it certainly is a different conversation, but it certainly gives investors a lot to think about.
It really does, and Wall Street is never boring, that's for sure. But what we've seen, at least over the course of the last week, is that volatility has finally returned. Volatility that was largely absent from the market in 2024, prior essentially to the beginning stages of July. We had 37 new record highs for the S&P 500 in 2024 alone. We're seeing the PE level of the S&P 500 above its 5- and 10-year averages. Prior to last week, we only had 2 days where the market moved by 1.5% or more. So this type of volatility shouldn't be all that surprising to investors, but the sheer magnitude of it caught a lot of investors off guard. And that's why I still contend, and we tell our clients at Hennion and Walsh, use this as an opportunity to look at your portfolios to see if you have the diversification in place that's consistent with your risk tolerance. In other words, if the market's going up, your risk tolerance shouldn't rise just as much. If the market's moving down, your risk tolerance shouldn't decline. You should stay true to your risk tolerance in all market. And these type of pullbacks often create investment opportunities.
Well, they certainly do. Look at 08, 09. Look at what happened during COVID. I mean, if you missed out on any of those opportunities, even if you want to isolate it to what we've seen over the past couple of weeks, certainly lends to good opportunities and some returns. And of course, it always comes down to what your time horizon is as well.
Absolutely.
Volatility could be great for a day and swing trader as well. I mean, we're thinking longer term, but there are opportunities out there for, I think, all sorts of investors. Joe, it's interesting, though, when you think about gold and what its impact is or how it's absorbing these macro impacts. I mean, this is a global asset class. It's not isolated just to what's happening here in the U.S.
100%. And I think, Kevin, what you said about volatility, we've seen higher levels of volatility in gold prices, and it's all been favorable for the price. And it's simply because of a couple of key factors. Number one, you have to look at this environment and you have to understand that it is global, and what impacts these assets can be global. Monday was a global event that kicked off one of the most shocking moments we've seen in a long time in U.S. equities, a yen issue in the U.S. market. We have drivers that are continuing to play out that are supporting the gold price. We're hitting record highs in terms of our prices this year, an unprecedented number of record highs for the gold price. And it's simply because of Eastern demand in the investor community, global central banks continuing to be supporting the gold price. And I love what you said about staying in the market, because that's the key with gold. Don't get emotional. Don't let the volatility and the movements scare you, because longer term strategically, the economic expansion and the market risk and uncertainty, those strategic drivers, they're going to keep the Western investor on the tip and waiting to come into the market, and that's going to keep pushing prices higher. So those strategic drivers are there, and a case for gold in this environment is strong. When it comes to like volatility and shocking moments in markets, if you look back at the equity drawdowns that we've had let's go back just to 2000, where you start with the bubble with respect to the internet bubble, you'll see that gold's average performance over those moments of equity, the largest equity drawdowns, the last 5, excluding Monday, 15% return on average. That's how gold performs in those moments. So to your point on diversification, you need that type of asset, that type of shock absorber in your portfolio when you have these moments, but stay the long course.
Yeah. Well, I mean, we also need to think about, we know gold, interest rates, the dollar, perceptions of risk. Of course, that's going to, whether it's equities, bonds, or the gold market, but I think we really need to talk about what's happening in terms of fiscal policy and potential, broader policy as we go through this election cycle. Kevin, it seems as if there hasn't been discernible policies from either candidate yet, and I think there's some confusion. It probably could be contributing to the volatility we've seen in the market.
I think it has to a degree. I think once Biden was replaced on the Democrat ticket with Harris, all of a sudden investors start to recalibrate who may ultimately win this election. Is that good for energy? Is that good for regulation? Where do financials stand in this regard? I'm not a political strategist whatsoever. The one entity that I look at that's a government entity that does impact what I do every day as a portfolio manager is the Federal Reserve. And what I will say that the Federal Reserve coming into 2024 was predicting 3 interest rate cuts at that point in time of 25 basis points each. After their March meeting, they maintained that outlook for 3 interest rate cuts of 25 basis points each. Then in June, they took away 2 of those cuts, pushed them out into 25 and 26, and maintained 1. I think where we are right now as a result of that jobs report that came out last Friday, we're back to the 3 interest rate cuts of 25 basis points each. But in my view, there's no need for an emergency rate cut at this point in time. And in fact, I think that would shock markets even more. But we're still on pace for lower interest rates. And we were joking before, it's fun to play the Fed guessing game. And when the first interest rate's going to occur, will it be 25 basis points or 50? But I think we would all agree over the next 2.5 years, rates are going to be lower, yields are going to be lower, inflation should start to moderate, and that's good for stocks, that's good for bonds, that's good for commodities such as gold. So if investors have that longer term horizon, I really do believe there are better days ahead.
It's like timing the market. You can't time the top or the bottoms. You can always get in at some point, but I think it's a fool's game. I know we're talking about gold, so pardon the pun there. But when you think about gold and its responses to policy, are there any discernible trends there? Because it feels as if we're talking about fiscal policy more this election cycle than we have before, just because of the nature of
well,
what
where
that
we
looks
are
like,
in terms
right.
of our debt levels, et cetera,
Yes.
and the playbooks that we know from both parties in terms of their ability or their inability to really tackle these challenges. So if you back up just a bit, we've recently published a piece because there's lots of talk around how an election will impact an asset. On the short term, tactically, to our point that we're making, which is stay in the market.
Yes.
The election outcome has a de minimis amount of impact on the gold price, and it might impact the flows of gold just a little bit. Like consumers might not like a Democratic ticket, so you might see an increase in small bar and coin demand in the US market. But the big move that you see with gold is once policies develop, and that's what you need to wait and see how both parties, whoever wins, develop their longer term policies, because that starts moving gold again, not only in the US against the dollar or with the dollar, with the rate environment, but it also starts impacting the global flows of gold. Now, right now, central banks have been the biggest story we've had for the last 1.5 to 2 years around the largest consumption of gold in terms of the categories that we track. Most of that's been driven off of 2 factors. Number one, their concerns around their homegrown inflationary problems that they're dealing with. This is all in our survey that we released about 2 months back. And then secondly, their concerns around what assets that they're holding in those reserve portfolios and how they're going to perform, dollar and dollar-denominated assets. So they're worried about that. Add to that geopolitical tensions, sanction-related risks, and this makes it a great environment for gold. So depending on how these election results come out, where we see policies develop, it's going to spike the interest for those foreign investors, those central banks, to continue to stay strong in the gold market and very, very focused on it as a reserve asset for diversification.
And I can't imagine them moving away. I mean, it's one of the most liquid markets in the world.
If
Where
you
else would
think
they
about
go?
the catalysts that would lead a central bank to potentially use gold as a component of their reserve portfolio, you'd have to look back in history and you'd see, well, Turkey used it to stabilize an election outcome within their own borders last year. So basically they said, hey, our lira is under pressure, we need to stabilize. They said, stop selling lira into the market, sell us the lira, we'll sell you gold. And it was an exchange program they did. They did a masterful job of using it to curtail concerns they had domestically. You go further back and you'll see that it was used in the war chest when central banks needed reserves and strong performing reserves to give them money in a time of stress when risk assets were under pressure. So it'd have to be a real big catastrophic kind of an event for them to start using it. But even then, it's when others will be using it as well. And that's fine for us because that's exactly the role we would want to play in a portfolio. It's a safe haven asset nature at that point.
Kevin, why do you think the market had such a reaction that it did based on what was happening in the Japanese market and the yen? It's not as if the other markets have deviated from what we're doing with our central bank policy.
I think there were three factors that led to this drawdown, if you will, that took place over the matter of 48 hours. First and foremost was the BOJ surprisingly raising interest rates, and that caused a reversal in that yen carry trade, of which hasn't been completely unwound just yet. Secondly, last week the FOMC did meet. They chose not to actually cut interest rates, and in fact, struck a little bit more of a hawkish tone than at least I was expecting. And then, of course, on Friday, we saw job creations come in well below expectations. The unemployment rate go to 4.3%. Put that in perspective, the Federal Reserve is only forecasting unemployment to end this year at 4.1%. We're already at 4.3%. And then we saw GDP growth slow to 1.3% in the first quarter. I think that all of that made market participants start to question not just a soft landing, but is this economic slowdown that the Federal Reserve's been trying to manage now for the better part of the last 18 months going to deteriorate into a recessionary period? Investors were grappling with all of that, and all of that led to a downturn in the market, most of which was obviously algos and institutional traders and hedge fund. It really didn't hit retail just yet, although we're talking to retail investors every day and trying to remind them to stay in the market. Here's one great stat that I always tell individual investors. There was a professor from the University of Michigan did a study over 31 different years. The stock market, 95% of their gains take place on just 1% of the trading days. Now, I've been doing this over 3 decades. I don't know when those 1% of the trading days are going to be, but I can guarantee if you're not in the market on the 1% of those days, you're not going to participate in the most significant rebounds that the stock market experiences. So it goes back to our original overlying mantra at the beginning of this panel discussion. It's time in the market, not trying to time the market.
So we have a lot of conversations, and I think what you're talking about makes total sense with the kind of conversations we're having, and where we have a lot of attention being paid right now by Western investors. And remember, Western investors have been holding their gold positions. They haven't been adding new gold positions, and it's simply because they're trying to grapple with the risk-adjusted return on their portfolio.
Yep.
The diversification and the kind of diversification you need to be able to stomach and stay in the markets when it's volatile. And I think that's where we're having an increased number of conversations. And most of the survey work that we've been doing has been signaling that Western investors are waiting for the biggest catalyst, which is the rate cut, because that opportunity cost will shift back to gold, but it'll also increase that landing scenario.
Yes.
And again, I agree with you that the recession word hasn't been spoken about 4 months. Now we're back to it.
Now we're back to it.
I guess the question is, did they wait too long to react on the back end, and are they waiting too long to react now as we're looking to evolve central bank policy? I mean, again, it's like trying to time the market. No one knows.
They don't have a crystal ball either.
Right.
And they're looking at backward-looking data. So by definition, they're always going to be late to the party. It's just a question of how late and to what extent.
Yeah.
I don't believe they have to go with the 50 basis point cut in September unless the data really starts to go downhill over the course of the next 4 weeks even further. But 3 interest rate cuts are back on the table. But interest rates are still going to be high.
Right. It's not going to dent your your credit card.
Still be at a 17-year high if they cut interest rates.
Right. But however, historically, interest rates, when we talk about mortgages, from a historical perspective, they are not that. We're not talking about the 80s here.
We're not.
No.
We're nowhere near those levels.
I think it's the direction. And I think that that's what's interesting for us when we speak to clients and when we talk about the rate cuts. Because you're right, what is 25 basis points really going to mean from a monetary? It's the spoken indication of the direction with which the economy is going to head.
It certainly
it affects the psyche. And I think the money in motion is so significant these days, and it moves so fast, as you can see on Monday, that you just want to make sure that you're putting in place the sound investment portfolio that can actually stomach and weather all of these different shocks to the moment.
Yep.
And I think that's
the market reaction is just, I don't know, it almost feels very amateurish. I mean, I would be more worried about why they are cutting, or why they're raising for that matter. That means more to me than just 25 basis points. It's not going to move the needle that much either way. I mean, we think about housing, it's supply, right? It's really about supply.
Sure, and I think a lot of investors wrestle with what's already priced in.
Yes.
We were talking about that a little bit earlier. Will mortgages be impacted? Is that already priced into the potential for rate cuts? And how to read all of these different factors. Very challenging, so it's hard, and it's probably not worth the energy to try and figure out exactly what it's going to mean from the explicit implications of a 25 basis point cut. It's more important to stay in market and stay with a portfolio that can have the right kind of diversification. And I think that from some of the talk that we've been having as well, I'll bring up cryptocurrencies. I think that they're demonstrating what their performance looks like. You'll hear a lot of people talk about cryptocurrencies and the absolute return you can earn from them. And I think we caution investors to say, don't think it's a new form of gold. Think about it as a risk asset and understand its diversification benefits, because you've got to look at it as a component of a bigger portfolio.
See, and you read my
Certainly
mind.
not a safe haven asset, though.
And that's what I wanted to ask you in terms of Western demand that you alluded to before. Do you think because of the appetite for alternative investments, whether it's cryptocurrency or it's private investments, that perhaps the demand for using gold as a diversifier has waned a bit, or that's not part of the equation?
I think right now the alternative to gold on the short term has been 5% on your cash. And I think that that's where it's been holding back new allocations to gold. If you look, and this is just 6% of the global investment market for gold, but if you look at the ETF market, what you'll see is that there have been outflows, and the ETF market will shout about that till they're blue in the face. But the AUM is up. So AUM's up 15%. Net assets in terms of net new units is down 12%. So you're seeing people's allocations remain stable and their actual interest in adding on hold. And I think where you're entering now is an environment where that interest level will rise again. So they're going to start to say, okay, now I need to start worrying about risk assets performance. And volatility is back on the table, as you pointed out, and that's the environment where you're going to see the Western investor come back. Now, if you look at the flows of ETFs, the last rolling 2.5, 3 months, over $3 billion have flowed into European ETFs, and we've got about $1.5 billion into the US. So Europe's moving faster and quicker, and the US is starting to pick it up. And it's actually giving us the telltale sign. The Western investors are emerging again. Now, this is going to be countered by what's going to happen out in Asia. So are the Eastern investors done with their allocations, or are they going to continue to be concerned about their own local investment portfolios? This goes back to what I said at the beginning of the program, which is if this doesn't make people think global, I don't know what will.
But Kevin, that should be good for the US market as well if all that cash is on the sidelines, right? Because if the risk profile does change, and money market rates do happen to go down, I mean, you're going to start to think about.
Yes, my only fear is that the individual investor who has largely been sitting on the sideline for the last 18 months in short-term CDs or treasury bills earning 5 and 5.25%. Now they see that the stock market was up 26% last year, up 16% through the first 2 quarters of this year, and they think they missed out on the bull market run, and they try and play catch up. What do they typically do? They go into what has been working, and they're likely going to edge into that crowded trade into the Mag 7 stocks.
Yeah, and then sell when it gets frustrating.
There. Yeah. Exactly. So that's when they need to sit, go through their investment time frame, what their true objectives are, their risk tolerance, build a diversified global portfolio of different asset classes that can weather these periods of volatility, but also take advantage of what's likely to come over the next 2 years when rates and yields are low and inflation continues to moderate.
I mean, the market's supposed to ebb and flow, right? Not everything goes from the bottom left to the top right of the chart. I mean, it can't be 2020 and 2021 every single year.
Yeah. You mentioned privates. I think it's worth just putting it on the table. I think it's a really interesting category. It's definitely got a lot of attention. I think your caution around doing the right level of analysis to get into a market, or don't jump too quickly into something. That's a market where you have to really understand what you're getting yourself into in terms of chasing that trade.
Well, it's concerning too because now you're able to buy them in slices, if you will, and it's more accessible and democratized for the retail investor, but it is an incredibly complex space, and you want to be careful of that overcrowding as well when it comes to allocation.
Absolutely. Diversify into gold if you have privates.
All right, gentlemen, I appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.